right, welcome everybody to the June Investing and Identity Forum. I'm your host, Travis Dre, founder CEO here at Liminal, joined by the typical cast and crew, Cameron D'Ambrosi and Dave Fields. Welcome, guys.
Heidi ho.
Exactly.
All right, jumping right into it. Obviously, it's the beginning of summer. So do you guys have any fun plans?
I'm planning to Google where it is that Heidi Ho came from. Beyond that, I'm kind of pretty booked this summer.
Cameron, any plans for you?
Decided to become an independent app developer to recreate the Clubhorn app that I used to use that's been pulled down from the App Store. The Hamhorn app that is touted as the replacement. The quality of the sample is not up to my standards. So stay tuned for that.
All right. Well, I'm glad. So that's good. You guys got some good summer plans. Let's jump into the content for this month. So obviously things are getting pretty interesting here in the identity market, both in a good way and a little bit of a scary way for some folks. We had some very notable news, though, coming to us from the FIDO Alliance, and we're going to be breaking these things down one by one, but FIDO, as well as the group of big tech companies with Apple, Google, Microsoft, all announcing what they're doing with the passwordless authentication. So we're going to talk more about that here in a minute. And then, of course, one of the bigger things that impacted us well beyond just the identity market is the Fed here in the US and the increasing rates. So we're going to break down what does that mean for entrepreneurs, investors, and how does that impact the digital identity community more specifically. And of course, we had some notable investments with Middesk and Incognia. Middesk taking down $57 million, co-led round between Canapi and Insight Partners. We've talked a lot about Middesk here over the months, over the last couple of years. In fact, their last funding last year we covered in depth as well. So you can probably take that from the website if you're interested in what we had to say back then. And then Incognia, one of our startups that we watch here quite closely at Liminal, because we think that they're doing some very interesting stuff around location-based risk, taking in $15.5 million from Point72 Ventures. We're going to talk a little bit more about Middesk here later in the episode. But we're going to try something different here this episode, where we're going to break down each topic individually between Cameron, myself, and Dave. So would love your feedback if you're a longtime listener to the forum. And so with that, going to kick it over to Cameron. FIDO, obviously this is a really big announcement. A lot of people worked on this for a very long time. This has been kind of, I'll believe it when I see it type of news. And then we saw it. So what are we talking about here?
So, the death of the password, favorite hobby horse, discussion point, fulfiller of Betteridge's law of headlines, where, if you have to ask the question, is this finally going to kill passwords? The answer is probably no. Except for this time, I think we may finally be on that glide path towards getting rid of passwords once and forever. So FIDO finally getting Apple, Microsoft, and Google, the big boys, if you will, on board with a passwordless standard. A lot of complexity and nuance to unpack here. Not going to burn my entire 5 minutes talking about the technical details, but in a nutshell, you see the word passkey above, replacing passwords, which are fraught with all sorts of peril, as everyone listening to this knows, with the notion of passkeys. That is similar to a password, but you never see it as a user. It is stored in your device's secure enclave. So basically, your phone becomes your password. You prove possession of your device, and then some second factor, which can either be a facial biometric like Face ID, or a PIN code or password. So there's your multiple factors for kind of secure multiple factor authentication. The stumbling block up until now has been to deploy this type of solution. There is no way to recover your accounts if your phone goes kaput. You drop it in the toilet, it gets smashed by a cab and breaks. You needed either a second backup device that you already provisioned, or you needed to write down and store your passkey, like a 16-word phrase. And if you forgot that, there was no recovering your account. You'd have to kind of start over from scratch. This announcement lays out that they have been able to put together a solution that lets people through either their iCloud account or their Google account kind of recover and re-provision new devices based on the account security for those kind of higher level super accounts, if you will. This is really exciting news because I think it paves the way for mass adoption of this technology, because the average person is just not going to adopt a passwordless solution that requires them to rebuild everything from scratch if they smash their phone. How should companies be thinking about this opportunity that are in the passwordless space? I think what is exciting about this opportunity is all of the companies that right now are reliant on traditional passwords are going to need, implementation guides, Sherpas, if you will, to help lead them up this passwordless mountain. Obviously, some larger companies are going to have the engineering chops to kind of deploy this themselves. I think many are going to need FIDO compliant integrators and solutions providers that help them get dialed into that ecosystem. So, if building your own password solution was prospecting for gold, I think this new business model is a bit more like selling blue jeans and pickaxes, which, as we know, maybe the people who made out best from that initial gold rush. Last but not least, what are the new business opportunities that we should be looking for? Just because we have gotten rid of passwords, that does not mean we're getting rid of fraud. We are, not destroying risk. I would argue we're reallocating it, much like the destruction of matter. It can't be destroyed. It just turns into a different form. When I burn this piece of paper, it becomes some heat, it becomes some light, it becomes some smoke particles and ash. We are going to see a shunting of the risk of account compromise that previously, stealing someone's password using credential stuffing was the low-hanging fruit. That low point of account security, I think, is going to move to the endpoints. It's going to move to the account recovery process. So a lot of pressure is going to be put on the mechanism for claiming that my phone is smashed and I need to provision a new device as the storage of my passkeys, making sure that Apple, Google, and those folks are really thinking hard about how to protect those areas. Because now, if I can convince Google or Apple to re-provision a new device as that anchor of trust, I can own all of your accounts. And I think the other vector that's really going to get some attention is social engineering. If you can talk someone into unlocking their account for you and then wiring the money that you're trying to steal yourself, it doesn't matter how many factors of authentication are in place, because the rightful owner of the account is going to walk through those and then do this malicious act on your behalf. So, user and entity behavioral biometrics, other applications that can suss out, we think you are being coached. These actions are incongruous with what we would expect you to do. Let's throw some warning signs, some flags out there. I think those solutions are going to see a lot more adoption, because those traditional channels for compromise, credential stuffing, normal ATO type attacks are not going to fly in this new environment. Sorry, that's 5:30, but pretty good for me, all things considered, I think.
Hey, Cameron, I have a question for you. Do you think there are any businesses that will be reluctant to adopt passkeys just because they won't want to have their relationships intermediated by Google, Microsoft, Apple, etc.? Or do you see this being kind of like just a no-brainer and everybody's going to do it now?
I mean, the eternal optimist that I am, I would hope that the benefits of moving away from having to maintain kind of your own independent password and, more critically, password reset infrastructure is really going to be the driver here. Like, I think there is a very clear dollars and cents business use case, like cold hard facts. This is going to save you money. It's going to save you pain. It's going to save you risk. And it's going to massively increase the ability of folks you can bring through your sales funnel when they don't hit like create your account. You throw a password recipe at them. They try their usual password that they're using. You tell them it's bad. It's a whole to do. And I think you see a lot of people dropping out, getting frustrated, and or trying to log in to transact, hitting a password, needing to do a reset, and then just dropping out. So I think those reasons are going to carry the day in terms of why platforms want to adopt this, as opposed to concern around, losing some of that touch point. Because I think that the password is just such an initiator of frustration for the average consumer experience, that this is going to offer some real tangible benefits.
Cool.
Awesome. I think that's really amazing. I think we're going to see a lot more of this, right? Where we've been talking about passwordless companies on and off here for the past couple of years doing this form. So it should be really interesting to see what happens. But moving on to a pretty different topic, actually, with Dave here, we're going to talk a little bit about the Fed. So not necessarily just an identity conversation, obviously some pretty big implications for everybody that listens to this webcast here, but what happened? What does this mean? What does it mean when the Fed increases rates? I mean, like, tell us a little bit about this and how this is impacting businesses.
So there's a couple of different kind of like questions that we have in here. So, the Fed, the Federal Reserve is responsible for controlling the monetary supply. It has a dual mandate here in the United States. That's one, to maintain stable prices, but also keep the economy as close as possible to full employment. So for the last decade or so, we've had historically low interest rates, largely because we were trying to figure out why we were below full employment coming out of the financial crisis, right? So the Fed kept rates low for a very long time, was just really starting the hiking cycle when ultimately COVID hit. And so rates were cut. There were a bunch of other sort of stimulative actions that the Fed took, which basically meant reduce rates to increase borrowing activity, to both to boost and stimulate consumptive behavior by consumers, but then also to lower the cost of capital for corporations in the hopes that then that would spur greater investment activity, which will lead to both, greater CapEx, but would also boost, sectors like housing, manufacturing, et cetera. So now I think there's some, if you listen to political discourse, I think people want to attribute it, we'll make certain arguments, but I think a lot of what we're experiencing right now is some of it's from COVID stimulus and the Federal Reserve's, the actions that the Federal Reserve took, so both fiscal and monetary stimulus. A lot of it's also just a result of the kind of war between Russia and Ukraine. So gas prices are up 75% since Russia invaded Ukraine. Russia and Ukraine provide something like 30% of the world's wheat supply. So for consumers, they're really feeling the pinch right now, both at the gas pump and for food. Combine that with still challenged supply chains and, throughout the world, and we're getting huge increases in consumer prices. And so to start to dampen some of that activity, the Federal Reserve is trying to raise interest rates, reduce some of the monetary funds, some of the monetary stimulus that's in the economy, and reduce both kind of like consumer behavior, or at least slow and slow activity in some of the other sectors of the economy. So that's kind of very broadly the actions that the Federal Reserve is taking. Now, why does it matter for private markets? The biggest answer is simply that a higher interest rate or a higher cost of capital just reduces discounted cash flow valuations, right? So that's why we've seen valuation multiples compress pretty significantly, right? So I think in private markets last year, we were talking about companies sometimes raising at 50 or 100 times revenue, whereas now, we're talking about companies on the high end earning something more like 10 or 15 times revenue, right? And that's because most Series A, B, C, even growth startups aren't really expected to become cash flow positive for at a minimum 5 years, and many times 10 years plus. So if that discount rate goes up just 2% per year, the present value of those cash flows is going to compress incredibly. So that's kind of the economics 101 of what's going on right now. Now, I think, what industries and markets are most impacted by rate increases, to try to make this more digital identity specific. I would probably draw a distinction between sort of stimulus, pro-stimulus or tech-enabled services versus, sort of disinflationary technology. And what I mean by that is sort of tech-enabled services, I would put, just to kind of put some names to it, I would include, companies like, say, DraftKings, Robinhood, or or Coinbase, right? So in 2021, that was kind of like the rise of like meme stocks, where we saw all this hilarious hijinks going on with things like AMC, was obviously the big one, but there were some other stocks as well. We also saw the big, run up in things like Dogecoin and certain crypto prices. And we had a big explosion in people sitting at home kind of betting on DraftKings. And a lot of that was people were getting checks in the mail. They didn't have a lot to do. And so just broadly speaking, there was a lot of money going into entertainment, and also very speculative investment activity. And for certain identity companies who are responsible for onboarding people, right? We had to, if you're 18, you have to make sure you're 18 plus and you are who you say you are, if you're going to open a sports betting account or Robinhood or crypto. But these are all what I would consider tech-enabled services, right? You could certainly do all these things. It's not clear that technology was really something new. There was, it was taking advantage of the mobile phone's interface, but like, was this truly disinflationary tech? On the other side of that, so anyway, so that was why we saw, I think, a huge run up for a lot of sort of onboarding companies and KYC companies. A distinction I would then make is putting more like, in disinflationary tech, I would put things like anything that's sort of like cloud, more on the enterprise, more B2B style technologies, where we have a new technology trend and it's actually enabled people to take a lot of cost out of their cost structure. So rather than just making something more convenient to do through a mobile phone, you actually have somebody who's actually fundamentally transforming the nature of how we do work or perform certain compute operations, ultimately in a way that offers cost benefits at scale, right? So that's disinflationary tech. To produce the same good or product, it now is going to cost less to do so. So anybody who's wed to disinflationary trends, I think is going to be, is going to have some tailwinds very soon, whereas kind of the more tech-enabled services, I think is going to be really, really challenging. So when we say like what opportunities are available to investors and entrepreneurs in a time like now, I think, I'm not a macro trader or a stock trader per se. So I'm very reluctant. I'm not making a call on like where the S&P 500 is right now and whether we found a bottom or it's going to continue to go down or not. But like we have had a very broad market sell-off, right? So it's the proverbial, this is the time where you have, the proverbial babies being thrown out with the bathwater, right? And so I think there are certain types of businesses that have been very well funded for the last couple of years because they were able to show incredible user growth. And I think those businesses are going to be really challenged, but I think companies that actually have a strong disinflationary story, strong unit economics where they can actually show that they've got a very identifiable path to profitability, I think those companies are going to be served very, very well. And so the last concluding comment that I would remind, and I talk about this often, which is that, identity is an intermediate good. It's not something that end users actually consume directly. When people say, identity is an enabler of inclusion, like that's actually what we mean. Like inclusion is this high ideological aspirational word. But really what that means in an economic sense is that like identity fundamentally enables all these things. It's an input to all of these things. And so understanding what the end market is and what that industry or market looks like in a rising interest rate environment is really going to determine how different companies perform over the next 3 to 5 years. And so I think, there are some companies that, because of the sectors they've been using, are going to be really challenged now because those sectors are going to have some real strong tailwinds. But I think there are some others that over the next 12 to 24 months are going to come out looking very, very well. And, kind of like lastly, what I would just point to is a company like Okta, I believe, just had an earnings beat and outperformed on like revenue. And so a company like that is still showing strong performance. Now, valuation is a different conversation. But there are companies that are going to continue to do very, very well. And I think it's driven by ultimately the fundamental dynamics of that end market. Is it true economic tailwinds, or was it something that was just being driven by low interest rates? And I think those are two different things.
I think that's very, very interesting. And, when we are talking to clients, obviously here at Liminal, we talk to probably equal parts private equity clients as well as, entrepreneurs and vendors in the space building products and solutions. And the questions that are coming in have changed from, what is the big market growth strategy opportunity to very tactically, how do we break into this market? And here, of course, we have two practices that are focused on both growth strategy and go to market, and just kind of seeing the switch over to, all right, no, we got to actually go execute against the plans. Let's go resize this market and not look at the TAM, but actually look at our SOM and see what we can add to it. So I think that we're already seeing kind of the fundamental changes as well, just in terms of how businesses are starting to respond to this. But very, very interesting, Dave. I'm going to keep us moving here, but I'm sure we're going to have some more conversations about that offline. And the last topic here is really about Middesk. I thought that this $57 million Series B was a phenomenal sign for the Middesk team, co-led between Insight and Canapi, with Excel, Sequoia adding on there. Obviously, it's a big Series B, but Middesk is kind of in the league of their own. Interesting to see how they've continued to build new products. And a lot of those products don't actually fit on our landscape directly. So obviously, they have additional services that go well beyond just the identity side. But as I kind of look at their existing landscape, I'm really dropping them in this KYB, this business identity verification space as their core and primary function and segment, but extending that beyond just the KYB piece into data aggregation, credit financial identity, KYC, and document verification. But really, I'm more interested in what are they going to spend that $57 million on? And obviously, it's about growth and it's about continuing to expand the offerings. But I really see them moving into these three other areas: fraud detection and risk prevention, regulatory compliance, transaction monitoring, and Kyle's background, which is in background screening. So I really see them kind of owning this bottom left section of our landscape for specifically businesses and helping support businesses on all sides of that platform, both for the business as well as for any merchant or platform relying on this information to make decisions, whether that's a credit decision for underwriting purposes, or if that is a decision for fraud mitigation purposes. So I think Middesk here has some really cool opportunities. This is where I expect them to land over the next year plus. So, you can go back and look at our old videos here from a year ago when they raised last time and talk about what they were doing. But this is where I'm going to put my bet on. And I know we are running out of time here, but wanted to quickly talk about our latest research, which is our outside-in report on identity networks. And so, very interesting outside-in report. Identity networks are something that are still semi-defined. We have existing identity network frameworks, and then what we perceive to be the future identity network frameworks, including a lot of what we're seeing out of Europe with EID structures and frameworks, both from a private sector as well as a public sector. So if you're a member and you're listening to this, check out your research catalog with the new outside-in report on identity networks. And then what's coming up, we have our liminal summer networking event for our members. That will be a night out at the ball game at Yankee Stadium. And our next member content report will be on the personal identity ecosystem conditions. Those are those 5 conditions we talk about quite a bit: the commerce, reputation, data protection, privacy, and inclusion. So breaking those down, what do those conditions mean and how to actually look at those from a product perspective? And if you're an investor, how do you make sure that you're not investing in something that's a little too stretched out across those 5 conditions from a consumer perspective? And so with that, I want to thank everybody for joining this month's Investing in Identity Forum, and we'll catch you next month.